Thought Leadership from PwC's National Office.
Hello, and welcome to our podcast today. I'm Heather Horan, PwC US Sustainability Technical Leader, and I'm so happy to welcome you to the next episode in our series talking all about sustainability reporting and the landscape today. And as those frequent listeners will know, this is this is actually our first video podcast series. So definitely, if you're listening, I would highly encourage you also check out our video if you'd like to watch as I'm having my chat with my guest today. So in this 9-episode series that we're recording, we're going to take you through the key steps in the reporting process and then really focus in on some of the key topics in our sustainability reporting guide. So very exciting. And today's topic is a very important one, and it's a term we don't use really in connection with financial reporting, although we're going to explain why it actually applies there as well. And that's the boundaries of reporting. And for this episode, I'm happy to welcome Diana Stoltzfus back to the podcast. So thanks for joining me again today, Diana. And looking forward to our conversation. And maybe I'll just start where I just was, which is this whole idea of boundaries. It just seems so unusual to us, but actually when you start to dig into it, it makes sense. And in fact, we do have this for financial reporting. But can you just give us the really high level what we mean when we refer to boundaries of reporting? And then we can dig into some detail.
Sure. Yeah, I think, as you said, we don't use this concept in financial reporting. So I think it's not intuitive to people. But really, it's identifying what are the entities, assets, and operations that are going to be included in your report. So we do have
consolidation.
Your consolidated financial statements. So the same concepts. So there's some nuances that we'll talk through, but very similar to thinking about okay, what's my consolidated financial statements? That determines what's going to be reported in it. So you need to come up with that same reporting boundary to determine what's going to be included in the sustainability report. And also what time period is covered by your sustainability reporting. And so it will follow your financial statements, but then there's also some other concepts of time horizons that we'll talk through as well. And then also, lots of companies go through changes in their reporting structure during the year, whether that's an acquisition or a disposition. And so how do you think about those changes in reporting and sustainability? Let me just see if there's a couple others. So I think one of the things that you touched on too was the financial statements. And that is a foundational concept within the reporting boundaries and really within sustainability reporting overall is a connectivity between the sustainability reporting and the financial statements. And so we'll touch a little bit on some of these concepts and starting to talk about how they connect with each other. And maybe one of the first things that we'll start with when we're talking about the reporting boundary is this concept of your own operations and your value chain. And that is something that's different in sustainability reporting versus financial reporting, is this consideration of what we're going to talk about as your value chain.
All right. And then I think just why do we care? If it has to be in the report anyways, does it matter if it's own operations or value chain? And I think it's probably important to highlight that here before we get into the detail.
Yeah, I think that's a great point, Heather. I think, when you think about your own operations, there's going to be certain disclosures and disclosure requirements, especially in IFRS where there's very prescriptive requirements. And there are certain things that are required for your own operations and for your value chain. And also when you're thinking about how do you gather the information, what types of impacts, risks, and opportunities are being reported, thinking about whether that's in your own operations or within your value chain could give rise to different types of risks and opportunities, as well as what types of disclosures you're going to provide around those, given that there's going to be different levels of action or prevention or mitigation that you can take for some of those.
Yeah, I think what's a bit funny here, maybe not completely funny, is the fact that reporting boundaries, as you said, that's basically your consolidated financial statements. So what do you include in the report? But we have for preparing the consolidated financial statements, you've had guidance going all the way back to one of the ARBs, 75 years ago, and then all the way to the present. We have, its own standards, same thing under US GAAP and IFRS. And for determining reporting boundaries for sustainability reporting, we have very, very small amount of guidance, other than, of course, the relationship to the financial statements. And there is some specific guidance which maybe does actually make it a bit harder. So I find that really interesting as we kind of think about that. That seems like the case for a lot of sustainability reporting.
Well, I think that kind of, as you think about the maturity of sustainability reporting and the maturity of financial reporting, as you've said, financial reporting has a very long history and has evolved over a very long period of time. And there's a lot of guidance and interpretation and how people have thought about it over a long period of time, whereas sustainability is relatively young. And a lot of these frameworks, it's the first time we're seeing mandatory reporting for this year, right?
Yeah.
And so I think that is a difference between. So I think hopefully the guidance will continue to develop, but I think given this connectivity to the financial statements, I think we lean a lot too on some of the concepts that are in the financial statements, but I definitely think there's some new concepts that are being introduced here that we're still really trying to fully understand. So we'll try to help companies think a little bit about how to start thinking through some of those.
Okay, that's helpful. And again, I think it's particularly for these topics where this connectivity with the financial statements is very important. I mean, obviously we see it other places as well, but this is definitely a place.
Mm-hmm.
So the one other point maybe I'd make here before we get into it is that the boundaries that we're going to talk about today is actually different when we're talking about GHG emissions to some extent. Well, yes. And so later in this series, Marcella Lewinsky and I will talk about that. So for listeners' benefit, just know that's coming. Anything you hear today, just close your ears with respect to GHG reporting because it is a different approach. So
right. That's a great point.
All right. Own operations, such an interesting term. I think it's a great description once you understand what it is, but what is it? Why do we use that term? Where does it come from? Like, what's the whole background there?
Sure. And just to start, maybe to your point around where does the term own operations come from? So own operations is from the IFRS. So the ISSB standards don't use the term own operations, but I think as we talk through it, the concept applies under both IFRS and ISSB. And to your point, because both standards require reporting of value chain information, I still think this distinction around what's your own operations versus what's value chain is important because when you get to the next step, after you've determined your material IROs and you're thinking about what's material information, that's going to differ depending on whether it's in your own operations or in your value chain. So maybe starting with like, how would you determine your own operations? So it's really thinking about what are the entities, assets, and operations that comprise your own operations. And the first starting point is your consolidated financial statement. So thinking about what is contained. So that's the reporting entity and all of their consolidated subsidiaries. And maybe, emphasizing that point, all of your consolidated subsidiaries. So sometimes in financial reporting, we'll have where you have a consolidated subsidiary, but the reporting entity doesn't actually own 100%, right? So they'll reflect 100% of the assets and income statement amounts, income and expenses in the financial statements, but then you'll show an allocation to the non-controlling interest, in the equity and income. But when we think about it from like a sustainability reporting perspective, the reporting entity is controlling that subsidiary and they're controlling those decisions around those impacts, risks, and opportunities.
As applicable.
As applicable. Yes. Sorry, we will use that kind of impacts, risks, and opportunities, which is a good point because impacts, risks, and opportunities are required under ESRS, but only risks and opportunities are required under ISSB. So
if you want to know more on that, tune in next week because Diana and I we'll talk more, but I had to at least throw that in there because I didn't want to throw off our ISSB reporters in the audience. So.
Yes. Good point. And so, when we're thinking about those reporting around those things, is the reporting entity really is controlling those decisions. And so 100%. And also, I don't know how you really have a proportionate risk or a proportionate impact.
No.
I think you're really evaluating what are those impacts, risks, and opportunities. And also sometimes in financial reporting too, there can be instances where there's materiality decisions that are made that maybe a subsidiary is not material and so they're not consolidated. When you're thinking about the financial statements overall. But from a sustainability reporting perspective, every single entity within the consolidated financial statements needs to be assessed for impacts, risks, and opportunities as applicable.
And I think one key thing there is I do think we've gotten so many questions. Well, the subs immaterial, but they're solely looking at that from a financial reporting perspective. And even under sustainability reporting, your financial risks and opportunities you may have different conclusions than you do from a financial reporting perspective. So definitely do not just write off those, some of those small subs that don't have a huge financial statement impact.
Right. And I think we've seen instances where there are financially immaterial subs, but there are, from a sustainability perspective, there are material matters in those subsidiaries.
Exactly. Agree. And I just want to rewind for a moment to these non-wholly owned subsidiaries. So obviously you're saying they control the reporting entity controls that entity. That is why it's consolidated. And so you're reporting 100% of the sustainability data. You don't get this non-controlling interest. Just want to clarify because you mentioned non-controlling interest. So.
Yes, that's right. You're reporting 100% of it. And that's really going back to that discussion around you're controlling those decisions. Therefore, you're reflecting the full amount of those impacts.
Now, I know there's a lot of other, I'll say, complicated decisions on all different types of entities, but maybe we can run through a few of them. So unconsolidated subsidiaries, how do you think about those?
So I think from an unconsolidated subsidiary perspective, that those would not be included. They're not in your consolidated reporting. So you would need to think about those from a value chain perspective. There are certain instances within the ESRS where unconsolidated subsidiaries need to be considered from like an operational control perspective, but those are in kind of very specific parts of the ESRS. So I think when we think about the reporting boundary overall, that those unconsolidated subsidiaries would not be included.
All right. And so then all of this is based on financial statements. But then I actually was talking last week to Val about the case that we have so many cases where there's like a holding company or other intermediate entity that's the one responsible for reporting, but in fact is not preparing financial statements because it's taking some type of exemption. So in that case...
Yeah. So I think we get this question a lot and people are asking, so do we have to prepare consolidated financial statements if we're not otherwise required to? And I think the answer is no, but you would still like apply the same concepts as identifying what are those entities, assets, and operations that would be required to be reported if you did prepare consolidated financial statements. So you kind of look at that same group of entities, assets, operations. But I think the other thing that's important to note is even in sustainability reporting, because of this connectivity to the financial statements, there's lots of disclosure requirements that do connect to the financial statement. So intensity metrics, your assets that are subject to physical risks, there's a lot of them throughout. And also thinking about what are the current financial effects of some of these sustainabilities, the anticipated financial effects. So I think even though you're not required to prepare a full set of consolidated financials, there is still going to be financial information at a consolidated level that's going to need to be prepared to support the sustainability reporting.
All right. Very helpful. Now, as I said, I don't want to go through every single different type of entity. However, I hope our listeners keyed into the fact you said entities, assets, and operations. It's not just entities.
Right.
So any examples of either operations or assets that you would highlight in terms of things you should be thinking about when you're preparing this boundary?
Yeah, I think one that comes up frequently, and Heather, you might even be more familiar with me given your background as an energy partner, but I think joint operations is a common type of operations that we see. And those are where you would have a proportionate share that's reflected in your financial statements of the assets, liability, income, and expenses related to maybe a site, an entity, an asset, or an operation. So you're not showing 100%, but a proportionate amount of it. And so I think that is an area where there isn't a lot of explicit guidance in either ESRS or the ISSB. But I think when we think about it, we would go back to the same principles of thinking about looking at what is included within your financial statements and assessing those for any sustainability matters to identify if there's things that need to be reported related to those. And then for the portion of the operations that are not included in your financial statements, I think that we would think about that as part of our value chain.
Yeah. So I think these are very tricky, right? Because you actually wind up one sort of, it's not an entity, but one arrangement that then maybe has two different types of impacts on your sustainability reporting. So maybe we'll come back to that when we talk more about value chain. And I guess leading then into value chain, I think this is one of the things when people are new to sustainability reporting, it's a little mind-boggling. It's like, okay, well, obviously, even in the financials, you have this idea of your customers, your suppliers, and otherwise, but you're not actually reporting information about
Right.
those, and you're not talking about their risks and their opportunities, their impacts as applicable. So I think, can you really explain what we mean when we talk about value chain, and then why this is something that is brought in from a sustainability perspective?
Sure. And maybe I'll start by talking a little bit about the definition and maybe even doing a quick quote. But it's really thinking about what are the full range of activities, interactions, the resources, and relationships that the entity in its business model has with the external environment in which it operates. And I think we really, in this, in IFRS S1 paragraph 2, I think that kind of helps bring to light this. So I'll just read this paragraph. Together, the entity and the resources in relationship throughout its value chain form an interdependent system in which the entity operates. The entity's dependencies on those resources and relationships and its impacts on those resources and relationships give rise to sustainability-related risks and opportunities for the entity. And so I think when you think about that and like why is that important? Obviously, those relationships, like if an entity is no longer able to get critical resources that it's using to produce its product, raw materials, its dependencies on its workforce to be able to create those value, right? And create those products and then its customers. So I think when you think about those dependencies and the impacts that it has on those create risks and opportunities for the entity. And so you have to think about more than just the entity itself. And I think especially when we're thinking about sustainability related matters and we're thinking about the environment and we're thinking about how that impacts the entity. And especially when we're focused on the ISSB, we're focused on risks and opportunities that comes in under ESRS too. But I think we can see this. I love the term, the interdependent system is really, I think, what I really like about that quote. And I think that really highlights why it's important to have this information reporting on the value chain as well, not just, how the entity itself is having these being affected by these sustainability matters.
Yeah. And I know you're going to give some more examples later, but one that really stands out to me when, we were first working on this is just this idea, okay, well, so I'm an entity and I'm buying various things. And if I'm reporting my financial statements, so I'm so profitable and all of this, and maybe I am doing great from financial point of view. But then if you dig into it from a sustainability point of view and you're using child labor and you're not protecting your workforce and you're polluting but it's not you, it's all your suppliers. Well, that's actually important information to know versus the company that actually is practicing, reuse and recycling and treating their work as well and all those different things. And so if you think about sustainability, the people providing supplies to me, the fact that I'm choosing where to buy from is such an important thing. And then as well as what products I'm selling.
Yeah. And I think that's, I was listening to a company talking about, they were a clothing manufacturer and they had sustainable practices. And they were talking about one of the key differences between them and some of their competitors was that they, instead of going out and producing a bunch of clothing that they hope that the market will like and buy, and, the amount of waste in fashion, especially fast fashion is really high. And they said, well, we design a product and then we wait for the orders to come in and then we decide how much we're going to manufacture. And so it takes a little bit longer for customers to get it, but it's
no one-day delivery.
No, but it's just, but it's just interesting. Like if you're making decisions as a consumer as to how you want to support sustainable practices, understanding those differences and how they're using their value chain, right? And when they're contracting to, supply the labor to develop their products and stuff, I think is important. And so to your point, that this is why the information of not just what's your operations, but maybe beyond is important, right?
Yeah. So then, Diana, I kind of jumped in before you really got into the detail, and we've used the terms and hopefully it's relatively clear, but I know we talk about upstream and downstream value chain. I think that people can get confused even though, so what is the upstream versus downstream value chain and how do you think about those?
Yeah. So your upstream value chain is really, I think the most basic thing is thinking about what are your direct suppliers, what's like feeding into, what's coming into your operations that then you're creating your products and your services. And then your downstream value chain is, your distribution of those products and services, ultimately your consumers, your end users of those products and services. I think the thing that's challenging too with both ESRS and ISSB is when we're talking about the value chain, it's not even just your direct suppliers and your direct customers, it's that second tier beyond that. And so,
and third.
Yeah, it can be ever expanding. And then also other contractual relationships, other business relationships, which I think is, kind of how we think about these that are outside kind of those direct contractual first tier relationships. And so I think once you get into that, it's, it can be really expansive.
Yeah. And I think, we've talked on this series about our sustainability reporting guide. And one of the diagrams I probably love most in the sustainability reporting guide is like a spider web almost, which shows going in different directions, the entities in the middle, and then these value chains. And then there's these spots where there's impacts, risks, and opportunities is applicable. And I love it for one thing, because the team of our staff spent time working together, bringing together a bunch of topics to develop this picture. But the other thing is, I think is helpful, but if I'm a company and I see this spider web that just keeps growing, how do I then think about, okay, what is the boundary on this boundary?
Yeah. And I think, they've tried to put out, especially ESRS has the value chain implementation guide, which I think is really helpful. And I would say both ESRS and ISSB kind of have this concept. It's maybe just a little bit more built out since ESRS has this implementation guide. But they talk about you don't have to identify each and every single actor in your value chain. And that what you're really trying to identify is where you think there's like material risk within that, or they also use the term hotspot. It's always hard to use these because we impacts, risks, opportunities, so we have to think about the words that we're using carefully. But I like the term that they use, hotspots. And so trying to identify those. And so, I think it's going back to thinking through what are some of those critical supplies. So, if you are making a product that uses, microchips, there's like rare minerals that are being mined somewhere that then are probably getting processed into a chip that then you're using to use in your product. So that's not just the chip, it's going back into those and how that gets there, and where are those minerals being mined, and what are the conditions that are there, what are impacts on, the communities and the environment there. So I think it's that kind of thing about thinking through what are kind of some of the critical components that might go into your product or service, or who are, end users down this, your ultimate end users, and that you may be selling to another business that then ultimately goes to consumers. So I think it's thinking through who are my critical suppliers, who are my critical customers, what are significant impacts throughout my operations that could create those areas, those risks and opportunities or those impacts.
All right. That's super helpful. So then if we start thinking then, I think you've gone through this, but just to make sure, so now I've identified my value chain. I'm thinking about these hotspots, but then how do I decide which ones I'm really going to report on?
Yeah. And I think that's thinking through kind of, that gets a little into our another episode, which is our materiality assessment process of thinking through the materiality of those. But I do think, there's maybe going through maybe two more examples of this kind of secondary, third. I'll just go two away, but you could go even further. But I think, like one example that we've talked about in practice actually is like a tobacco grower. So a farmer grows tobacco, they sell their tobacco to a cigarette manufacturer, and then that cigarette manufacturer sells those cigarettes to customers. That obviously can have a negative impact on the health of those customers. And so thinking through, or, if we want to take it from an ESRS perspective, there's also lots of laws and regulations around cigarettes and, areas where, you can't sell to certain ages or other things. And so, thinking about whether that creates risks or opportunities or impacts those people, you as the tobacco grower need to think about that, even though you're not directly selling to those customers.
Yeah. And then you said two examples though.
Oh, yes. And then another one too, which I think this one is interesting too, is thinking through like financial institutions. And so a financial institution might provide a loan to a company, and maybe that company's operations, significantly pollute the local environment. That financial institution will need to think about, does that pollution that company is doing, given the connection through that loan, does that create, impacts or risks to the financial institution? If they're causing major pollution, like maybe they, could be sued or go bankrupt, right? And then they won't be able to repay the loan. So I think we try not to just think about impacts, even though they're easy to think about. But, I think you have to think about the full risks, opportunities, and impacts.
Yeah. And I think maybe the key thing here is we still hear companies coming to us and saying, I'm only looking at my first tier. And so that would mean the ones that you have the direct relationships with that. And I guess if you don't take anything else away from this podcast, value chain is not just tier one.
Right. So. And I think when you're thinking about, the full life cycle of your product or service, I think that's really what we're trying to get at, right? From like the inception of that product all the way through its ultimate. And sometimes that even includes, the end of life treatment of that product too.
Yes,
right?
I think people get so focused on
like, okay, I
their
bought
suppliers, and then like what happens at the end is definitely something to think about. Well, and that's, again, we see companies that they have their turn-in programs and otherwise, and that is, going into that aspect of the value chain.
Yeah, and so I think, another thing that we've heard is around kind of like mapping out your value chain or creating some sort of way to think about all of that spider web that you're talking about.
There you go. All right. So we could definitely, obviously, talk much more about the value chain, but why don't we jump into then the other aspect of the reporting boundaries that I think is key. Another one we don't really think about from financial reporting, but actually it's like inherent in financial reporting, which is the time boundaries. And I kind of love that term. But what do we mean by time boundaries then?
Yeah. And maybe we'll start with the basic is just what report period are you covering, right? What period is your sustainability report covering, which is the same as your financial statement.
One thing that's easy.
Yes, so it will cover the same period. But I think there are some concepts within the sustainability reporting that is a little bit different than from our traditional financial statements. And so when I think about, what are you reporting within your sustainability statement? You're required to report your impacts, risks, and opportunities over the short, medium, and long term. There's also anticipated financial effects of sustainability matters, as well as, what is an entity doing related to its targets and goals? Those could be over, various periods of time, as well as then what are these actions that the company's taking to prevent, mitigate, or remediate any impacts or risks or pursue any opportunities. And so for the IFRS, they define what short, medium, and long term is. So for short term, it's 1 year from the day of the financial statements. Medium term is after that period through 5 years. And then the long term is more than 5 years. Companies, if they did want to define time periods differently, they could do that. They would need to provide disclosure around that. The ISSB standards do not have any they still use the term short, medium, and long term, but don't have any prescriptive requirements around what those time horizons are.
Before you go on then.
Yes.
Why? Like, why did IFRS define them? And then any insight into that? I think it's interesting.
Yeah. I think one of the things that we've heard from sustainability reporting, moving from this voluntary landscape to mandatory is one of the challenges with the voluntary reporting was inconsistency in the information that was provided by entities. And so I think having more definition around what is the short, medium, and long term then hopefully provides more of that consistency and comparability between and among companies. But I think on the flip side of that, we also know that different companies have different planning cycles, different life cycles of their products and services. And so they may not fit well into predefined terms. And so I think the ISSB standards, which is more principles-based, I would say IFRS is more prescriptive and ISSB is more principles-based. I think they went with that principles of having those still short, medium, and long term, but allowing entities to provide, and they're required to provide disclosure around how they've defined those time horizons, but then you would be able to see that gives a little more flexibility to companies.
Yeah, this is an interesting one to me because you did see IFRS and ISSB go in different, or FRAG and the ISSB go in different directions on this. But on the other hand, it's interesting because in many cases, you're actually going to wind up in the same place. And particularly, obviously, short term is basically the financial statement, like 1 year. But anyway, it is a place where there's a difference, but maybe not really a difference.
Right.
Well, I guess it depends on the particular company. But anyway, I jumped in. So what else from now that I cut you off, you have to see where you were.
Maybe a couple other concepts that I think, one, maybe that's more specific to sustainability reporting, and then a couple where we tie in more to the financial statement. So one is the concept of a base year or a baseline year. And those are really important when you're thinking about an entity sustainability related, like targets and goals, usually having their base year, their baseline year, and then how they're measuring progress against that is really important to understand that. It is really common when we're talking about GHG emissions, when we're thinking about base year. So we will leave that for another discussion, another podcast, but just to at least introduce that concept is out there related to time horizons. And then the few other things is, one is subsequent events. There's no specific guidance in the sustainability standards, so we would think about it very much the same as you would from a financial reporting perspective. So if you're getting information after the end of the reporting period, but it relates to the reporting period. So an example could be like you get a new pollution report about an operation that was part of your reporting during the year and it was material, you would update for that. If you had an event that happened after the year end, you would evaluate whether that was material for disclosure.
All right. Very helpful from that point of view. And then how about I'll throw a couple more. How about comparatives?
So comparative. So it does require comparative information. I think that helps users look at trends, look at how things have changed over time. So that's helpful information. One thing to note is a lot of both actually reporting standards provide transitional relief. So for the first year of reporting, comparative information is not required.
Good news.
Yes. A little bit of relief there.
All right. And then you made me think of another question when you mentioned, I don't know why this pollution report reminded me of this, but if you have a change in your entity structure during the year, obviously this happens a lot. You sell something, you buy something, you discontinue and operate. Like there's just so many different scenarios.
Right.
So it's pretty straightforward when you think of this little org chart that never changes, and that's what I'm reporting. But now, you have these changes. What do you do with them?
We're going to follow the financial statements.
All right, so easy.
So I guess, as you're thinking about that, like, what does that really mean?
Yeah.
Right. So we'll stick with the basics here, and maybe we could get into more complex situations later. But if you're thinking about, say you have an acquisition during the year, I think you would think about, do those new assets, do those new operations, are there new impacts, risks, or opportunities that come with those assets or operations? So they would just flow into your normal process of assessing your entire reporting operation to determine your material disclosures, and then thinking about, do you have new policies or actions? I think maybe the one interesting piece is kind of the metrics piece of it, right? You have metrics that could be reported as of a period end, or you have metrics that are reported kind of, we like to call them flow metrics, or maybe we don't.
Even though
they cover the entire
period.
The entire period. So I think, if you, from the date of acquisition through the end of the year is what you would include related to those assets or operations. And then they would obviously be included in any year-end metrics. Disposal, you would just have the same, where you'd consider, does that change in any way your materiality assessment, the disclosures that you would require? And for metrics, you would include them through, the beginning of the reporting period through the disposal date. And then at the end of the period, since you don't have the asset or operation anymore, it would not be included in the metric.
I mean, it does seem rather intuitive, actually, but it's definitely something that we've spent a lot of questions and we've spent a lot of time on, so that, there could be more complex situations. Right. But all right. So Diana, I know there's more to this, but I think we hit the highlights. So again, if you're a company, you're thinking about different aspects of these boundaries, what advice do you have, or what sort of key takeaway would you have here?
Yeah, I think maybe two key takeaways. I think one is, and we've tried to highlight this, I do think that this connectivity with the financial statements is critically important. And I know we'll talk about that more in some of our future podcasts. But I think you can at least stick with, like, when you're thinking about kind of your own operations and what you're reporting, I think we can think about you leveraging a lot of the principles from financial reporting. And I think the one, at least major area of difference in my mind, is the value chain. And I think that is something that companies really need to focus on. And I think it's going to take the entire company, right? Because you're really going to have to think about what are your products and services, and how throughout kind of their entire life cycle, how they're interacting with different entities and businesses and what types of relationships they have. And so I think that mapping of the value chain and trying to identify where those hotspots are, areas of heightened risk, I think is really critically important. And it will take a lot of people outside of, whether that's financial reporting or a sustainability reporting function. It's going to really encompass, operations and thinking through all the different aspects of the company.
Yeah. And I think the other one for me that stands out, so you mentioned short, medium, and long term and reporting over that. And again, we do have that concept in financial reporting. So for example, if you're doing valuations or otherwise, but to me, it's not the same, because in this case, you're actually reporting information about what you think, what is your risk going to be? Is a flood going to occur? Or, what could happen in the future? And to me, it's more directly part of the reporting that you're making. And so again, a lot of judgment that's involved and a lot of people in the company that may be needed.
Right. Yeah. I think especially the longer term you get out. And I think some of these too, when you think about, some of the commitments that companies are making, like those can be farther out. And I think those commitments are being made potentially farther out than when we typically think about like a company, if you think about your budgeting or your planning from more of a financial statement perspective, those are usually a few years, whereas some of this stuff that companies are thinking about that are targets or goals or what their plans are to transition to, a greener economy, that those are over a longer period of time. So I definitely think that the time horizon is longer in the sustainability reporting.
And that leads directly into materiality, which is a perfect ending because that's what we're going to be talking about next week. So to our listeners, definitely please join us again next week. I'm going to have Diana back again, and we will be talking about materiality. So going into this impacts, risks, and opportunities as applicable. And for today, Diana, it's always such a pleasure to talk to you. And thank you so much for joining me.
Thanks, Heather. Great talking with you.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.